who buy up entire supply chains years.
FINRA volume. We are
Overwhelming control, up to 76.80% stock price.
That is an interesting point, though I wouldn't call it desperate. I'd call it adapting to the
Treasury buffer evaporates. And if the
141% of its market cap.
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
Right now, if we look at the latest price action and off-exchange volume metrics for Hyperscale Data Inc., trading under the ticker GPUS, we are looking at a truly fascinating market reality. Just to set the baseline here, over the last few sessions, the stock has been trading at approximately 18 to 20 cents a share. And yet, if you dig into the balance sheet, the estimated net asset value sits considerably higher. It's somewhere between 35 and 52 cents per share. But here is where the mechanics get incredibly interesting. And frankly, this requires us to slow down and really look at the tape. Off-exchange short volume has completely dominated recent trading. It frequently exceeds 50% of total volume. On February 27th, 2026, it reached nearly 63%.
Yeah, it's massive.
On that single day alone, we saw 3 million short shares out of roughly 4.9 million total FINRA volume. We are dissecting a company undergoing a radical, highly complex transformation. They are pivoting away from their origins as a diversified holding company formerly known as Alt Alliance, and they are attempting to become a pure-play AI data center and Bitcoin treasury operator.
Which brings us to the core tension we have to untangle today. Is this stock a profoundly undervalued infrastructure powerhouse, one that is being validated by massive institutional accumulation and deep insider conviction? Or, if we look past the AI buzzwords, is this actually a highly speculative vehicle, one fraught with execution risk and an existential threat of dilution that ultimately favors the insiders at the expense of the common retail shareholder?
I fall firmly into the first camp. The company's aggressive AI infrastructure build-out, their elite institutional backing, and their digital asset treasury, they represent a fundamentally sound, visionary transition.
And I come at it from a very different way, because when I look at the aggressive capital structure proposals, the heavy cash burn, and the way this dark pool liquidity is being managed, it points to severe execution risks and what looks like a looming dilution trap for everyday investors.
Well, let's start with the hard assets, because I believe this strategic pivot is backed by highly tangible catalysts, and more importantly, by what we call smart money. We're not just looking at a narrative shift on a corporate slide deck. We are looking at concrete being poured and hardware being racked. The company's Michigan data center is currently undergoing an expansion from a 30-megawatt footprint to a massive 340 megawatts. And for those following the space, you know this isn't generic legacy server space. This facility is being designed explicitly for power-intensive high-performance computing, the exact specific GPU workloads required for modern AI training and inference.
The megawatts are real, I will grant you that.
But it's not just the megawatts. The strongest validation here actually comes from the capitalization table. We have witnessed a staggering 4,600% surge in institutional ownership. The Vanguard Group's entry is the headline here. They took down nearly 21 million shares, which gives them roughly a 6.47% ownership stake. BlackRock has also shown a massive percentage increase in their position. In the microcap space, seeing this level of capital deployment from Tier 1 asset managers isn't just a blip. It serves as a definitive institutional seal of approval. It tells us that the underlying infrastructure value, the access to power and compute, is recognized by the absolute most sophisticated players in the broader market.
Look, I hear the enthusiasm for the hardware, and the Vanguard filings certainly catch the eye. But I think that narrative of a pure-play AI company, it obscures a perilous financial reality. The balance sheet tells a story of massive systemic cash burn. We are talking about negative 58% operating margins in late 2025.
Well, building infrastructure is expensive.
It is, but that is the grueling, real-world cost of trying to build out 340 megawatts of advanced infrastructure. And to fund that massive deficit, we have to look very closely at how they are actually raising the capital. Specifically, look at the upcoming March 18, 2026 special meeting proposals.
The proposals to increase authorized shares.
Exactly. Management is requesting an increase in authorized shares from 500 million to 2.5 billion. I want everyone to think about that multiple for a second. They are also seeking approval for a Series H preferred conversion. If approved, that conversion could essentially hand their affiliate, Alton Company, up to roughly 76.8% control of the entire enterprise. When you combine that looming structural dilution with the massive off-exchange short volume you detailed in the introduction, it paints a very different picture of what is happening. The institutional dark pool activity isn't just some passive seal of approval. I argue it is actively masking a structured dilution mechanism.
I see why you think that, but let me give you a different perspective on that institutional presence. Because it is not just Vanguard acting in a vacuum. State Street has initiated a position of 1.8 million shares. Geode Capital Management increased their position by over 2,000%. These are massive passive and active accumulations happening simultaneously. We are entering what many analysts are calling the sovereign silicon age.
Right.
In this era, access to baseline power and raw compute is the ultimate scarce resource. These institutions are the primary providers of massive blockchain and infrastructure-focused ETFs. Their buying validates Hyperscale Data status as a legitimate proxy for AI and digital assets. You simply do not see State Street and BlackRock accumulating millions of shares in a $70 million microcap unless their quantitative models have identified a deep structural mispricing relative to the physical data center assets being built.
I am sorry, but I just don't buy that it's purely a value play. Let me tell you why, by looking at the actual market microstructure. Yes, those institutions are showing up on the 13F filings. That is a fact. But look at the mechanics of how this stock actually trades day to day. We established right at the top that off-exchange short volume is frequently exceeding 50%. Now let's look at the specific organizations facilitating the capital raises. Hyperscale Data has an at-the-market and ATM sales agreement with Wilson Davis & Company for up to $35.4 million of Series D preferred stock. They also have Spartan Capital Securities leading an amended $50 million ATM for Class A common stock.
Which is completely standard for a company in a high-growth, high-capex phase. They need a mechanism to sell shares into the market to fund the concrete and the cooling systems.
It is standard to use an ATM, yes. But for those who might not monitor market plumbing, an ATM basically means the company can create and sell new shares directly into the open market continuously, like an ongoing drip of dilution. And here is where it gets concerning. Virtu Financial, one of the world's largest market makers, is sitting on the shareholder roster with over 827,000 shares. This indicates to me that these institutions are actively hedging and internalizing risk. They are utilizing these dark pools, the off-exchange trading venues, to absorb that constant at-the-market equity dilution. It is not simply a bullish, long-term, diamond hands bet on sovereign silicon. It is a highly structured off-exchange operation designed to manage the liquidity required to keep the company funded. They are moving massive blocks of shares off the public tape so they don't instantly crater the stock price.
That is an interesting point, though I would frame it differently. The mechanics of raising capital, even complex, off-exchange mechanics, do not negate the fundamental strength of the operational pivot itself. We have to look at what they are actually building with that ATM capital. It is a fully integrated technological ecosystem. Let's look at their software subsidiary, Ask ROI. On March 5, 2026, they successfully deployed the Claude Opus 4.6 model on their platform. They didn't just put out a press release. They have the metrics to back it up. They surpassed 1.3 million downloads across the Apple and Google App Stores.
But how does a software app tie back to the heavy infrastructure in Michigan?
Because this software vertical connects directly back to the physical racks they are building. They are deliberately targeting what is known in the industry as the neoscaler niche. They are preparing to support advanced liquid-cooled NVIDIA Blackwell racks. We are talking about the exact kind of dense, high-heat infrastructure that Dell is putting together right now, racks that cost nearly $2 million apiece. By providing the exact highly specialized physical environment required for those specific deployments, Hyperscale Data is securing a highly defensible, high-margin position in the AI supply chain. They aren't just selling space. They are selling an environment that very few facilities can actually support.
That is a compelling argument for the end state of the facility, but have you considered the immediate execution roadblocks inherent in that strategy? I totally acknowledge the theoretical long-term value of a 340-megawatt campus. The power footprint is real and power's gold right now. But bridging the gap from a 30-megawatt facility to a 340-megawatt Blackwell-ready liquid-cooled facility requires navigating severe global supply chain constraints. Right now, mechanical, electrical, and plumbing contractors, the MEPs who actually build these cooling systems, are completely flat out. There is a massive labor shortage and a component shortage for things as basic as high-voltage transformers.
Which every data center operator is dealing with right now.
Exactly. But here is the reality check. Hyperscale Data is currently a $70 million market cap company. They are trying to procure these massive transformers, advanced cooling units, and highly specialized labor during a $650 billion global capex boom, a boom that is being driven by Amazon, Google, and Microsoft. How does a micro-cap company successfully compete for those severely constrained resources against trillion-dollar giants who buy up entire supply chains years in advance? The theoretical value of the completed facility is high, absolutely, but the execution risk to get there is astronomical.
The execution risk is significant, I concede that, but it is mitigated by the sheer conviction of the leadership team, who are putting their own personal capital on the line. We have to look at the aggressive insider buying by Executive Chairman Milton C. Alt III. The data here is unambiguous and frankly quite rare for microcap undergoing this much capital expenditure. In a 90-day window leading up to early March 2026, insiders bought a net 4.5 million shares, and crucially, there was 0 shares sold. Mr. Alt alone deployed immense personal liquidity.
He has certainly been active on the open market.
Highly active. On December 31st, 2025, he executed purchases totaling over 1 million shares. The day before that, he bought 560,000 shares at prices ranging from 18 to 19 cents. He is consistently buying at a massive discount to those net asset value estimates of 35 to 52 cents. When the executive chairman is personally accumulating millions of shares on the open market, it proves immense internal conviction. He sees the day-to-day progress of that Michigan facility. He knows exactly where the MEP contractors are at, and his capital deployment signals to the market that the current 18-cent valuation is severely disconnected from the underlying reality of the assets.
I understand why you point to the open market purchases. It looks great on a headline, but we have to deconstruct the larger structural control mechanisms at play here. Specifically, that Series H convertible preferred stock financing we touched on earlier. Alt & Company is providing up to $100 million in financing. On the surface, that sounds like phenomenal insider support. But you have to read the fine print on the conversion mechanics.
You mean the floor pricing?
Right. The conversion has a floor of 10 cents per share. If that Series H preferred is fully converted at that floor price, it could result in the issuance of up to 1 billion new Class A shares. 1 billion. That grants the affiliate overwhelming control up to 76.80% of the entire company. So while the open market buying looks good and builds retail confidence, the Series H structure effectively dilutes common stockholders into oblivion while the insiders secure the underlying value of the assets. Furthermore, this is a company facing a real threat of an NYSE American delisting. They are seeking approval for a 1-for-2 to 1-for-5 reverse stock split at that same March meeting just to maintain exchange compliance. Consolidating shares just to stay listed alongside massive authorized share increases is evidence of structural distress, not just a temporary market mispricing.
I see why you emphasize the dilution risk. The sheer number of authorized shares proposed is daunting if viewed in isolation. But let me give you a different perspective on how the company is actually defending its balance sheet during this incredibly capital-intensive phase. The dual asset treasury strategy is, frankly, a brilliant hedge against the data center's operational cash burn. They aren't just holding cash that gets eaten by inflation. Their digital asset treasury, or DAT policy, has resulted in the accumulation of just over 610 Bitcoin as of March 1st, 2026.
which is a highly volatile asset to use as a corporate backstop.
That amounts to roughly 141.9% of the company's total market capitalization. They are trading for significantly less than their highly liquid Treasury assets alone. Zero value is currently being assigned to the 340 megawatt expansion by the market. Furthermore, they just announced a 100,000-ounce strategic silver reserve program. This is an astute macro debasement trade. By holding hard assets like Bitcoin and physical silver alongside the real estate of the data center, they are building a multi-layered reserve. It protects shareholder value from broader inflationary pressures while the Michigan facility matures and goes online.
I will concede that those assets hold real, verifiable value on the balance sheet. Holding over 600 Bitcoin is a formidable reserve for a company of this size. But we have to frame this strategy accurately. It is a desperate race against time. The company is relying almost entirely on the appreciation of Bitcoin to outpace the unsustainable operational cash bleed of the data center construction. When you have negative 58% operating margins, that Bitcoin treasury isn't just a clever, passive inflation hedge, it is a vital lifeline. This strategy effectively turns what should be a straightforward, predictable infrastructure play into a highly leveraged macro speculation.
I wouldn't call it desperate. I'd call it adapting to the realities of the current cost of capital.
But think about the downside risk. If the price of digital assets faces a sustained downturn, which Bitcoin is entirely capable of doing, before the Michigan facility reaches profitability, that treasury buffer evaporates. And if the Bitcoin buffer evaporates, the company's left entirely dependent on the exact ATM dilution and dark pool mechanics we discussed earlier. They will have to sell more shares at lower prices just to keep the lights on, triggering the very dilution spiral the retail investors are worried about.
We have covered an immense amount of ground here, from market microstructure to gigawatts of power. But for me, GPUs presents a rare, deeply discounted asymmetry in today's market. You have a company trading significantly below its combined cash and Bitcoin reserves, holding over 141% of its market cap in liquid assets. Beyond that, you have a 340 megawatt AI data center expansion targeting the highly lucrative neoscaler niche. And this isn't just a retail dream. It is fully validated by elite institutional accumulation from Vanguard, State Street, and BlackRock, working alongside heavy, continuous insider buying. The fundamental assets and the strategic vision here are exceptionally strong, even if the road to get there is complex.
And while the hard assets, the megawatts, the cooling infrastructure, and the Bitcoin are certainly real, the corporate structure surrounding them is a minefield for the common investor. The heavy dark pool shorting, the staggering proposal to authorize 2.5 billion new shares, the reverse split, and the potential 76.8% insider control via the Series H conversion, all of it presents an unacceptable dilution risk. The infrastructure potential is massive, yes, but that does not negate the very real mathematical possibility that retail investors may be structurally diluted out of their equity long before that potential is actually realized.
I think where we absolutely converge today is on the underlying value of the physical and digital footprint. We both agree that the core assets at play here, the massive 340 megawatt capacity being built in Michigan and the 610 Bitcoins sitting in the Treasury, possess undeniable, tangible value in the current macroeconomic and technological landscape. The divergence lies entirely in whether the complex capital structure allows common investors to safely realize that value over the next few years.
Precisely. Analyzing microcap transformations in the AI era is incredibly complex work. Truly understanding these companies requires looking far past the technology buzzwords, the App Store downloads, and the flashy press releases. It requires deeply examining both the balance sheet and the off-exchange market mechanics that keep the whole operation funded.
It really does. And with that, we will leave it to the listener to form their own conclusion regarding the viability of this structural transformation. Thank you for joining us for this analysis.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!